Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called Alboflation, the Energy Edition. Australia is one of the largest energy producers in the world, but we also have some of the highest energy prices. Energy prices are falling in other parts of the world, but they are remaining high here. Is this a function of the government, the energy cartel, or are there also other factors at play? Join us today as we delve into this paradox. Just a quick reminder, this podcast is general advice only and is not intended to be specific to your personal situation. If you do want to discuss your personal financial situation and how to improve that, you can book a call with me or one of the advice team at nucleuswealth.com/contact. Today, as always, we have Nucleus Wealth's co-founder and chief investment officer, Damien Klassen. Welcome back.
Hey, Sam.
Hey, Damo. My name's Sam Kerr. I'm the head of advice at Nucleus Wealth. Just a reminder, the themes discussed in this podcast are a reflection of our thinking in all our active portfolios. You can find out more about our offering in the description notes below. This show is recorded live every Thursday at 12:30 Australian Eastern Standard Time. So jump onto the Nucleus Wealth YouTube channel and ask any questions that come to mind, and we'll do our best to answer them during the show. The podcast is also available on all major podcast platforms, so feel free to have a listen there if you prefer as well. So those are the formalities. Damo, over to you to get the ball rolling.
Yeah, thanks, Sam. So I wanted to have a run through the some of the changes that we've seen in terms of energy prices. So we ran about a couple of months ago a podcast looking at the oil price increases that we've seen, and positing the question, is that going to lead to cost push inflation, and do we have to be concerned about secondary effects? And we sort of, given the rest of the macro environment, we came to the conclusion, no, it probably wasn't the major issue in terms of second order effects, and that it was probably going to be more restrictive in terms of pulling back on the economy rather than pushing the economy forward. Now the question is effectively the opposite. Is the pendulum swinging the other way now? Are we seeing low energy prices, and is that going to sort of push things further down? So I just wanted to run through that compare and contrast about what we spoke about a couple of months ago, and then what we're talking about now, and what the big changes, and I guess why these changes have come about, and what that might actually mean for investment portfolios and inflation sort of more broadly. So so might jump sort of straight into that. And we spoke about the geopolitics last time, about this idea that we've got this problems in the Middle East, and will Iran become involved? Will the US sort of stop looking the other way on Iranian sanctions? What's happening in the Russia and Ukraine and Russian oil in particular, and gas, and then China, about how much sway China had over the events. And I think a large conclusion was basically that, look, it seemed relatively well contained. It seemed that the what we'd see is that Iran was in the position of had effectively achieved what it wanted to do, which was to sort of blow up the discussions between Saudi Arabia and Israel. And so it would be wise to keep going with it. And I think we're largely in that same place again. They might still decide to escalate, and we might still run into issues, but for Iran to effectively achieve its goals without risking any of its own troops seemed to be a bit of a win for them, that they probably should just take and move on. And what that's meant is we've seen this real crash in energy prices. So I've got the coal price up. I'll start with that. Now that's obviously not probably should have started with oil, but it's a similar type of chart. So I've seen that coal price in the last 2 months really come down from the sort of 200 plus to the sort of 150-ish level, and lower a few days ago, but sort of bounced back a little bit. We've seen that similar type of trend now in the US. Actually, this is the LNG prices. So we're looking at Asian LNG prices, and they've sort of come down from $18 to $11. So again, not quite halving, but down 30-40% in terms of prices from when the when we first saw that Middle East conflict break out. And so and below the sort of the lows we had just prior to the conflict, I think, which is a pretty similar trend. And so this is on the energy side. So so I should have prefaced this by saying, so if I'm talking about energy, our big worry last year was that Europe is going to run out of gas with losing the access to gas from Russia. In response, they did a whole bunch of different changes, and they had a very mild winter, and so they're sort of saved in a way by that mild winter. But as a second part, they've rolled through a lot of changes throughout the economy. They've got a lot more liquefied natural gas coming now in over by tanker, and so there's still danger this winter if it turns significantly worse, so significantly colder. You could see these run down, but by and large, if it's anything like just an average winter, then they should be fine. And I've got a chart just sort of showing where the various levels were in terms of the gas reserves that they had. And so that goes through this cycle where they build up big gas reserves, and then they come into winter and run down those gas reserves. Now, it's a little hard to see on this chart, but the red line is 2021. There's some dotted lines showing the 5-year range, the top and the bottom for the prior 5 years, and then we see the 2022 numbers in there as well. And so this year, what we've seen is that the 2023 is basically above, a reasonable part above, sort of 10-15% above the levels they've had before. They had last year, I suppose. And even above the highs they had over the prior 5 years. So lots of storage. We've got a lot more LNG coming through. They've had a couple of cold weeks in the recent parts, depending on where you look. But by and large, the forecasts are for a relatively mild winter again. And so that sort of seems to say that there's not a lot on that gas side. And what that means for Europe is that energy prices are going to be down significantly on prior years. And so this flow through in terms of lower inflation and allowing the central banks to maybe not go as hard and to factor in some a bit of relief for consumers and government spending. So that's that. The US gas prices have come down as well. So US gas prices are significantly lower than the rest of the world. So the US, and this was because the US gas used to be sort of trapped in that they couldn't export it, and the US gas is a bit of a byproduct for a lot of the shale oil. So whereas in Europe, the gas that they're getting in Europe is gas that's been produced elsewhere for the purposes of energy. A lot of the gas within the US is actually a little bit different in that it's from the shale oil people who are looking for oil, and the gas is a byproduct, and so they're just happy to get rid of it at whatever price. And they actually used to flare it, so that they used to literally burn the gas because they were busy pulling the oil out, and that was the valuable part. And the gas was like, nothing to do with it, so we'll just flare it off. Restrictions have now come on for a lot of those and broader gas networks. And so what's ended up happening now is that the gas prices are still kept quite low in the US, but they're now exporting that to Europe, and they're looking to basically double the amount of exports over the next couple of years. And so very low gas prices compared to the rest of the world, like a fifth or lower of the rest of the level. So 80% lower than what you see in the rest of the world. But that gap should narrow as more US production comes on. So looking so far, the gas and coal, we're looking at prices down significantly. We might go then to you, Sam, for a quick message, and we'll jump onto oil after that.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Yes, so so I was talking about oil. So the oil price as well has come back from sort of $90-ish. Well, depending upon which one you're looking, but let's say we're talking about US oil, come back from $90-ish to $70-ish. And that's been this other sort of real driver of, we were talking about it before, even last time we were running, I was saying that the fact that the oil price hadn't run up significantly higher was actually a little bit of a sign that there was potentially some more weakness in the US economy than what we thought, and in the global economy than what we thought. And I think that's where the point is that what we're trying to, what we were sort of hinting at before was that there was these signs coming out that maybe the demand for oil and other products wasn't as significant as what it looked like it probably should have been, was that might be a sign the economy is weaker than what we expected. And that's basically the way it's the way we've seen it go. And so oil's this real input cost into a whole bunch of other things. So anything that needs transport, it goes into construction, it goes into mining, it goes into plastics, polyester. So anything that's using any of these, oil's this input cost into it, and that can really drive the costs higher. So what part of the reason for the thought about that, and part of the reason why we're looking at it, was that we wanted to sort of isolate, could the higher oil prices we see end up being into this cost push inflation? And so now the question needs to come the other way. Is this the fact that oil prices are falling and energy prices are falling? Is that going to mean that the oil is going to be? Is it going to mean that we're seeing inflation go the opposite way? And we've sort of titled the whole thing the Alboflation, because that isn't necessarily the case as much in Australia. So we are seeing the oil prices come down, obviously, but we're not seeing the same amount of energy price decrease that we've seen in other countries. And I've got a slide up just showing the gas prices within Australia. Now, there's this gas price cap of $12 that had been agreed. And the thing with the gas price cap is, this is sort of this part about, we had high prices. We had as the war started in between Ukraine and Russia, these gas prices went crazy. Australia's this massive exporter. For anyone who hasn't sort of listened into some of those prior episodes, effectively the short version is Australia's a massive gas exporter. Every other country has put on either restrictions or gas reservation or tax, whatever it is, in it, so that if you're a gas producer and gas prices go sky high, your local companies don't suffer. Now, in Australia, we've basically got two different markets. The West Coast, which did exactly that, the textbook version of this is what you do when you're a big oil producer or gas producer, is you put on the reservation or things like it so that local companies don't face higher prices. The East Coast was convinced that no, that's not necessary. We've got so much gas, it'll never be an issue. We'll never have to worry about prices. And lo and behold, we did. And so, and the Labor government has got this real problem in terms of it sort of got kicked out of office last time because it sort of ran a campaign against the mining companies and tried to put on mining royalty taxes, and they lost government. They lost prime ministers over it, and they've had this real fear, despite the fact that in the mining case, a lot of them were Australian companies, whereas in this case, they're almost all exclusively international companies. And so we're left at this point where the gas price actually hasn't changed that much. And it's because we've got this cap of $12, despite the fact we've seen gas prices in Asia come down sort of 30-40%, we haven't seen the same effect in Australia as much. And so we're not actually seeing quite the same push through. Now we are seeing lower energy prices. Having said that, in recent weeks, I've got another chart showing the national energy market weighted average price, and it's got the day-to-day ones you can see, and then the thick line is the average line. So that's definitely coming down from what it was, but it is still. There's still some of the recent lines are certainly starting to point up, and we're seeing some prices well above that. And also, it's not coming down anywhere near what we're seeing overseas. So I think that it will, we will see some easing in Australia. It's not going to be as bad as it was. But the other thing is, we're not seeing it to the same extent that what countries are seeing overseas, because we're effectively allowing our cartels effectively to dictate prices in Australia. So the Alboflation's a little bit tongue in cheek in that we will see some easing. We're just not going to see the same type of easing we saw elsewhere. And we'll go to you, Sam, and then we'll talk about what that means for investments and supply.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defence contractors. You can find out more at nucleuswealth.com. Now back to the show. Just one more quick thing. We just want to ask you for a simple favour. We want to spread the message about transparency, innovation, and integrity in investing. At Nucleus Wealth, we live and breathe these values. We would love it if you can help us spread that message, and subscribing to our channel will help us do that. We would be most grateful if you can hit the like and subscribe button now. So, Damo, before we move further, I've got a question. I mean, we've got this sort of $12 price cap. What I'm curious to understand is, are these energy companies just sort of, hovering around this maximum price that they can sort of get away with and not bringing it down in line with the rest of the world? Do you think that's at play?
Yeah, absolutely. I think if you speak to the oil guy, if you spoke to these companies, they would have lots of good reasons as to why the prices need to be higher, and it's a global market and all this stuff like that. But I think the net effect is we have a cartel. We have a small number of suppliers. They can access higher prices internationally. They're buying up as much as they can locally in order to keep the local gas and the local away from pushing prices down locally. And so I think if you just did a quick East Coast gas comparison versus West Coast gas comparison, and in the West where they have to reserve, prices have been low and stayed low, and on the East where they don't have these reservations, I think it's a game about how loudly people squeal. And I think we've been in an environment with high prices, and we've been in an environment with lots of inflation. I think the customers have largely, they've done a lot of squealing, but they've largely got used to the higher prices or gone out of business. And so I think there's it's a little bit of a familiarity is sort of bred out the problem, and that these guys, I guess, these local users, and particularly, say, households, they're not looking at saying, just a minute, gas shouldn't be the same price in Australia as what it is in Asia, because it's our gas. We're producing it here. We've got to freeze it, send it all the way over there, and we're selling it for the same price as the gas here that's coming out of the ground and going a few hundred yards or a few hundred kilometers up the road. So there's no reason why that same gas should be selling for the same price as what it is when you've got to literally send it hundreds of kilometres up to Queensland, freeze it, stick it on a ship, send the ship over to the country, drop, then unfreeze it to bring it back out again. So I think there is there'll be lots of protestations from the gas companies themselves about the reasons why, but I think the net effect is they'll charge whatever they can.
Mm.
And well knowing that the governments in Australia are not really going to. We talk about having these triggers, and they talk about having all these issues and things they're going to do, but the reality is they know they're not going to.
Yeah, I guess that was sort of a question in my mind as well. Like, is there actually any chance for this sort of reservation? But I guess if government's been burnt in the past and it's already sort of seems like it's set in stone, maybe there's slim to no chance of getting something in place.
Our best chance is that renewable energy continues to grow and gas demand starts to tail off, and then maybe these will come down. But yeah, there's and I think as well the other thing is it is a confusing issue, and it's not as simple as I think it's as simple as these guys are basically overcharging, but they've turned it into a more complicated story in world markets and things like that, and they turn it into a more complicated story so that people don't really, they're like, I don't really understand it. Seems complicated. Yeah. Maybe they're right, as opposed to no, you shouldn't. The gas shouldn't be selling for the same price if it doesn't have to be picked up and frozen. Like picking it up and freezing it should roughly. And transporting it should roughly double the price from local ones. So, whatever you sell. So if you're selling at $6 here and another $6 to freeze it, send it overseas to get it to $12 in Asia, that's about right. Whereas we're paying $12 here and they're paying $12 in Asia. So,
yeah, it doesn't quite add up, but what can we do? That's right.
Well, we're looking at Santos and Woodside looking at a merger at the moment. So. Taking more of the having fewer gas companies. So add some more cartel members, or add another. Make one of the cartel members bigger. Mm-hmm. Right. So the question then is on this supply destruction, because that's the other question we go now is saying. So with oil prices low, there's a few different parts you can come out of this. One is the positive side, and you can say. Effectively the reverse of the argument we were talking about last time, which is when you spend $20 less on your petrol each week, then that's more money you have in your pocket. And then, maybe you go out and eat, or you stay out a bit longer. Maybe not to say the $20 is going to buy you much, but there's maybe that's an extra drink or two that you're going to have out at the pub. And that money then sort of, circulates around in the local economy much more. So money that you're spending, more. If you spend another $20 that goes to an oil company in Saudi Arabia or wherever, then that doesn't actually circulate in the Australian economy, and it sort of pulls money out of the Australian economy and sends it overseas. Whereas if that money is now circulating in the Australian economy, I buy a few extra drinks at the pub, and then the pub gets a little bit more money, and then they spend it more on staff, and those staff members then go and do other things with theirs, and that money sort of keeps. You get this multiplier effect. And so we spoke before about this idea that above $100 oil, you got this demand destruction in terms of people were spending money and, that spending would kick in, and that, above $100, it tended to mean lower inflation. As you look at this, now we're back into this sort of, $60 to $80, the relationship becomes pretty linear in terms of we look at that means that lower inflation expectations start to get built in. And for the oil guys, it's a question about when do they start switching off the taps and going, okay, well, if I was happy to sell oil at $90, but at $60 or something like that, I simply can't afford it. Now, the problem with oil is the cost curves for oil are very movable. So I've got a chart up just sort of showing this new oil that can come on and how much it costs. And so if we look at, say, Saudi Arabia, Their break-even cost is about $20, and could be as high as 30, could be as low as 10, depending upon which fields. And then you go through each of these factors. The US shale sort of goes from somewhere between $40 and $80, and there's quite a lot of it in terms of that's a really big one. And right at the top end is the Canadian heavy oil, which some of it you need $100 a barrel to break even. Other ones you can do for sort of $40 a barrel. Now, the issue with this curve is it's not as fixed as you think. A lot of the costs that are coming out of this are actually taxes, and the taxes based on the price. And so what happens is when the price halves, well, the taxes halve. And so there's a lot more malleability to this curve than you might think. And what it means as well is for anyone who's already built something, if you've built something, your marginal costs are nowhere near these costs. So you might have, this might be saying your break-even cost is $60, and it might well have been on, but once you've actually built the pipelines and drilled the oil and you've got it pumping through, your marginal costs are probably more like sort of $15 or lower. And so when do you actually stop pumping? Well, you need that oil to fall a long way before you actually stop pumping something you've already started up. So that's one part. The second part is that the US shale has completely different dynamics to the rest of these markets. Most of these other markets are talking about, if you're going to do the investment, you probably need to look at running it for 20 years or more to actually get a payback. And given the outlook and rise in electric vehicles and things like that, there's fewer and fewer companies willing to take those long-term bets. But luckily, US shale only runs for 2 or 3 years, or you get most of the oil back in 2 or 3 years. So they've got a much shorter time frame, and they are a bit more reactive to prices. We haven't really seen them starting to scale back yet, and production has still been growing in the US. Maybe these recent falls we've seen might see a little bit of scaling back, but the other side of it is in the US, what we've really seen over the last 10 years, what's different to where we were 10 years ago versus today, is that a lot of the US shale 10 years ago was owned by just small players, whereas a lot of it now is owned by the oil majors. And what that means is that you might have had an oil shale producer, for example, who they had a break even of $70, and the price was 100, or it might have been, whatever the price was. They were just going to pump. That was their only acreage. So that's what they were going to use, regardless of what the price was. If it fell below 70, they might stop, but largely they were going to produce. Whereas because the oil majors own a whole raft of different places, they'll have some expensive ones, some cheaper ones, and some really cheap ones. They're out there actually saying, well, we're not going to drill the $70 oil one yet, because we've got a whole bunch of ones we could drill at the $40 and $50. And then so they'll keep chipping away at those ones, and then eventually they'll do all the best ones first, and then they'll gradually work their way up to the more expensive ones. And so I do think we're going to see less less supply destruction from these lower prices in US shale, because now they're owned by much bigger companies, and they can the bigger companies can actually factor in the prices, and they're just going to leave the poorer ones until prices are higher, or they can lock in those prices high enough that it actually justifies it. And just to illustrate what I was saying about that moving supply, I've got a chart up from that might be Wood Mackenzie, maybe one of the. Oh no, actually, maybe this is the Goldman Sachs one. Sorry, I've forgotten to source this one, but it's just showing the that same oil curve over time. And so you can see that in 2009 we had this oil curve which was like, we can only produce 10 million extra barrels per day from new sources. Otherwise we're going to be paying like $120. But by 2017 there was 4 times as much you could produce before that line went vertical. And so and I guess that the part of the point of that is a big input into this is what actually is the current price, because that affects the affects the taxes. And then the second part is there's lots of other factors and supply and other things coming on and efficiencies that sort of send this line all over the place as time goes. So I guess the net effect of that is, look, at low enough levels, you see oil price destruction. And the biggest positive I think you can see, say, for oil prices at the moment is that because of all the uncertainty and all the ESG, there's a reasonable chance that we're not going to have enough. There's going to be some gaps in supply at certain times over the next sort of 10, 20 years as we go through this transition. But knowing when that is and being able to take advantage of that, I think is going to be difficult. For me, it's about saying, well, oil prices are closing in on $100 or $200, $100 plus, then I'm absolutely thinking about jumping out of those stocks and looking elsewhere. When oil prices get down to maybe $50 or below, now I'm starting to think, okay, are there some short-term possibilities within that? And then somewhere in between, I'm a little bit more agnostic about what I want to have. But I do know that we're in this period now where we spoke before about being surprised that the oil price hadn't risen further, and maybe there was a sign of a weaker economy than what we thought, and that is seeming to reflect now in the current stats that we're seeing.
Excellent. So now we've got our question of the week. So this is for viewers to have some discussion in the comment section over the coming days. And the question this week is, it's a bit of a longer one. 2 months ago, investors were worried about high oil prices and inflation. Now it's low oil prices and deflation. Has the pendulum swung too far? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And Damo, back to you for investment implications.
Yeah. So I guess my thoughts on this is, no, I don't think the pendulum has swung too far. I think we're into a phase now where we're going to see some reasonable easing of inflation on the back of oil prices. Now, this is going to affect headline inflation, not core inflation. We spoke last time about how central banks strip out oil prices when they look at and energy costs when they look at inflation, because what they really want to see is they want to see these underlying core bits of inflation. What are they doing? Now, within the US, what we're seeing very much is services inflation still running pretty hot. One of the biggest parts of that is the housing inflation, which has turned down, and we're going to start seeing some negative prints coming out over the next few months. It just takes a little while to filter through, but it's still running relatively hot. Food inflation, look, it's above average, but it's no longer concerningly above, and so that's the food part, and then the net effect on fertilizer costs and all these other factors should actually start to flow through into the food inflation and lower oil prices. Energy inflation's negative, and it looks like it's going to be negative for a little while. And we've got goods deflation. So the goods prices that really drove that inflation at the start of the cycle is now turned quite firmly negative. The net effect of all this is we've still got inflation that's above target, but it's primarily services driven. Because now we're looking at lower energy prices and that headline inflation being lower, that sort of turns this issue into saying, okay, is that going to help soften the blow for the rest of the economy, because there'll be more money around for consumers, and consumers might actually spend a little bit more than what they might have done with high oil prices. And so that's certainly factoring into it. But it's also factoring in that the inflation impulses we've seen look like they're going to be going away. So unless you see some sort of rapid escalation or problems, rapid escalation in tensions in the Middle East or other problems sort of start to flow up, it does look like that inflation issues we spoke about have pretty firmly disappeared. And certainly in the last couple of days, even more so. So we sort of set this topic up at the start of the week, and with much higher bond yields, and every day that sort of seems to come out, and we saw a relatively dovish Fed, is that we're seeing more and more signs that that inflation impulses have well and truly peaked, and quite possibly we're looking at sort of the end of rate rises in the US. More problems in Australia because of the amount of crush loading, the amount of new people we've got coming in, and the lack of we're not going to see the same effects on inflation as what we spoke about. So and given the Aussie dollar has had a monster rally as part of this, our thoughts are now that you need to be looking more internationally. So that the concept that Australia will see through and not have the same sort of deflationary impacts, we think is wrong. We think that will come, it might just be a bit more delayed, and so there will be we're looking for further exposure to different themes and different stocks where we think you'll get benefit from this. And for us, the Aussie dollar is now was a headwind for you over the last month or two, but the rise has been so rapid and so quick that now it's time to actually start loading into some more international equity. Feel
awesome. Thanks for that, Damo. We have had a comment through from Jeff Robinson. Just like to get your take and see if you got any thoughts on it. He's saying US shale is rolling over. It's too efficient. It's too quick, and the Permian basin is the only area holding up for now. Have you got any thoughts on that?
Is that I think I'll just come back to that thought that keep in mind the US. So you're absolutely right in that US shale production is, and the capex cycle is much faster than you see anywhere else in the world. So, and the reason why is because if I have an oil well, say in Africa somewhere or offshore Africa somewhere, is that I'm building that. It's going to start, say it's going to pump whatever, 1 million barrels a day. That's going to be 1 million barrels a day, and it's gradually going to fade off over 20 years to 500,000 barrels a day or something like that. If I look at a US shale one, it might start pumping 1 million barrels a day on day one. By 2 or 3 years later, it'll be down to 100,000 or 200,000 barrels. It's just such a huge fall off that you get in terms of the amount of oil. Now that sounds really bad in that I'm not for one of these wells that just lasts forever. That's great. But the issue is for the rest of the world, for planning purposes, for I guess society as planning purposes, you can make a decision on a 2-year well really quickly. You can say, yep, I can lock in those prices. I can build this well. I can get 80% of what I'm going to get out in the first 2 years. I can see that's going to meet my cash flows, and I can even hedge that far. And now I can make a quite much faster decision. Whereas that 20-year, you can't hedge that 20-year, and you've got to spend that and just hope that oil prices are going to be high enough. And so the decisions to come both on and off for US shale is much faster, which does mean they'll pull back much faster. But the issue as well is on that, given we've now got the much bigger companies, they can actually just go out and drill all the best ones. And I think that's where I think the fall off won't be as fast as what we've seen in prior cycles, but they will lift faster when it comes on. I think, does that answer the question, Katem, or do you think of?
I think so. That's some good insights. So hopefully, Jeff resonates with those. And if anyone else has got any questions, feel free to ask them. One other thing I want to add, as always, in this section, as the viewers would have heard, we do have around 100 different screens and tilts. With the screens, you can screen out all fossil fuels, so any stocks that engage in fossil fuels, and also the worst offenders. And then there's also, you can screen out any GICS sector materials. Then on the other side of the coin, with the tilts, we can add in extra stocks. We've got a specific oil and gas stocks tilt there. So if the oil prices, getting down to those lower bands, like Damo mentioned, it could be worth putting some extra exposure in there. Or with the tilts, you can do them as standalone portfolios as well. So that almost wraps us up. And we will continue to tell the story as it unfolds. So thanks for listening. We'll see you all next time. So just final thoughts. We do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comment section below or send us an email to contact@nucleuswealth.com. Also, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you do share it with them also. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.